Hello and welcome to another episode of Trust Issues. Today I'm speaking to Ryan Lightfoot-Aminoff, one of our Kepler Trust Intelligence analysts, to talk about BlackRock Smaller Companies. We're going to share our thoughts on the fund, including BRSC's investment strategy, current portfolio allocations, recent performance and the outlook for UK small caps, amongst other things. Ryan, many thanks for joining us.
Thank you for having me, Joe.
To start proceedings, could you talk us through the opportunity for investors in the UK small cap sector?
Yes, of course. The UK small companies asset class provides growth capital to immature businesses looking to generate long-term returns. It's arguably a really good incubator for these sort of earlier stage companies that wish to use public markets to raise capital, prove themselves, and then go on to grow into the large caps of tomorrow. The UK index has been a really good starting point for what are now global leaders in their space and continues to exhibit a plethora of firms that are leaders in their own industry niches. Examples include industrial firms that manufacture really high-end precision equipment, and therefore they have dominant market positions where it's difficult for others to challenge them. They can exhibit pricing power accordingly, and are therefore able to generate good free cash flow. This means these businesses are more nimble and flexible by being smaller. Therefore, they can adapt to changing markets as well, which enables them to capture market share from perhaps bigger players and continue to grow. So as a result, small caps tend to offer better earnings growth over the long term. So for example, since 1990 to early 2024, smaller caps as constituted by the FTSE 250 and FTSE small cap indices, produce median earnings growth of 12.6% versus about 9.3% for FTSE 100. Now, this has helped contribute to historical share price outperformance over large cap indices as well. So, for example, over the 10 years to 13th of December 2024, the FTSE small cap X investment companies index has returned just over 117% versus about 93.5% for FTSE 100. However, whilst long-term performance has been excellent, this hasn't come in a straight line, and smaller companies have had periods of volatility and drawdowns. In these periods of volatility, such as we're experiencing right now, small caps often trade at a discount to larger cap peers, despite the arguably higher long-term growth potential. Right now, valuations are below historic averages in the small cap end of the market, with the FTSE 250 and small cap X investment trust indices trading at respective discounts of 34% and 49% below their 10-year average forward price earnings ratio. The sector also has much lower research coverage. This allows active managers more opportunities to capitalize on pricing inefficiencies and allows them to identify overlooked companies and therefore help generate above average returns.
And moving on to the trust, could you provide an overview of BRSC's strategy and its investable universe?
Of course. So manager Roland Arnold is focused on identifying high quality companies using a bottom-up approach. This is supported by the wide resources of the emerging companies team at BlackRock. This strategy and the process that supports it has been in place for over 20 years, and due to its success, has been adopted more widely amongst other teams at the firm, including on the large cap desks. The range of company sizes that manager can invest in starts from around 100 to 150 million and will rise up to about £2 billion. These can be companies that are listed on the FTSE indices as well as on the alternative investment market, aka AIM. This offers the manager a wide range of companies and industries to invest in. However, if a stock were to perform particularly well and be promoted to FTSE 100, Roland would sell it down. The portfolio will typically contain between 100 and 120 holdings, and these are split between core and incubation names. Positions will be sized based on the opportunity and valuation, though Roland remains very conscious of liquidity, which needs to be a consideration at this level of the market. As such, a target stock's market cap will be considered before he decides how large a position will be, with target weight set for each stock, as well as price targets. This is part of the discipline of the process, meaning if a stock goes through with 3% weighting, Roland will take some profit from the holding. But equally, if the share price falls back for no other reason than sentiment or weakness, and nothing underlying has affected the investment case, he will look to top up his position.
And what attributes does Roland typically look for in a potential investment?
So the typical features that Roland looks for are capital light business models with high levels of recurring revenue and high cash balances that can adapt quickly to changing market conditions to achieve long-term growth. These firms will often be market leaders in their niche with well-capitalized balance sheets, enabling them to be cash generative. It is unlikely to own firms or industries that are reliant on financial leverage like debt to support their businesses. Furthermore, he has a strong focus on governance, meaning these firms that he looks for will be run by good management teams with strong long-term track records. He believes that firms with these characteristics are likely to offer sustainable returns over the long term.
And changing tack slightly, could you provide an overview of the current positioning of the portfolio?
Of course. So, as a result of the focus on those aforementioned quality characteristic, trust typically has overweight to the likes of industrial companies and specialist finance firms and those focused on the consumer with a very specialist business model. In contrast, the trust is usually underweight the likes of resources, banks, and utilities, as these firms are not usually the creators of their own destiny and are reliant on external forces such as commodity prices and interest rates to drive their success or failure. Should be noted, though, that these industries are not particularly popular sectors at the smaller end of the market cap spectrum. The number of stocks in the portfolio has come down of late, with the portfolio now towards the lower end of its range at about 100 companies. The reasoning for this is twofold. On one hand, some stocks have left the portfolio due to the likes of M&A, which has been a major factor in the small cap market of late. Whilst on the other side, there has been a lack of new companies joining the market, with weak sentiment towards smaller companies and therefore low valuations, putting firms off undertaking IPOs. This is part of a broader trend in the UK small cap market. And as a result of Roland's disciplined process, he is waiting for the good opportunities to come along before investing. One of the themes of the trust positioning is exposure to the house building sector. This has materialized in a subsector overweight to construction and materials and includes the likes of real estate investment trusts. Other overweights include industrial support services, media, and electronic equipment. This reflects in a type of companies that are capital light and can be flexible and nimble in order to be market leaders in their niches. On the other side, Roland is underweight oil and gas and coal companies, those operating in precious metals, and food producers, primarily for their reliance on external forces such as commodity prices.
And moving on to performance, could you share your thoughts on BRSC's recent performance?
Of course. First, for a bit of context, due to the trust's bottom up stock selection approach, this should be the primary driver behind performance. The lack of research at this end of the market and the depth of the BlackRock research resource has allowed the manager to identify many overlooked opportunities and benefit from these being latterly recognised by investors and therefore enjoying a re rating. This process is supported by the depth of the analyst team at BlackRock. Roland is part of a team of analysts that support the process, all of whom are generalists, meaning everybody can provide equal input. The team, including Roland, will undertake many company management meetings, usually with at least two analysts, to quiz management on their assumptions and help build a full understanding of the firm's approach. More recently, the trust has broadly performed in line with the market. There have been many examples of good stock selection in the likes of Funding Circle, which benefited from a quick return to profitability sooner than expected due to a restructuring and sale of its loss-making US operations. The company had a very low market cap at the beginning of the period that it was invested in, meaning it was only a small part of the index, around 0.1%. This was likely too small for many peers of Roland's to look at it. However, because of the stock selection approach, it was an average 0.6% position in the portfolio and has therefore generated significant alpha as the trust has re-rated and performed very well.
We've seen a number of headlines about bargain hunting for UK companies, particularly by overseas and private equity buyers. Has M&A been a feature of the portfolio, and what's your view on the outlook for M&A over the next year?
Yeah, so M&A has been a feature both across the index and for the trust. BRSC has benefited from some M&A activity, so a takeover of portfolio holding Lock and Store was beneficial to performance. This was bought out earlier in 2024 and added alpha to performance. However, M&A more broadly has been a bit of a headwind for the trust. Lots of the bigger detractors have been stocks that were unowned due to Roland's disciplined quality approach and that have been bid for, pushing up their share prices. This has meant that the line between outperformance and underperformance has been very narrow. It has also contributed to fewer ideas to recycle capital into when the portfolio holding is acquired. However, with valuations still very low versus historic levels, this could continue to be a factor next year, though Roland points to an element of luck being involved, whether it affects a portfolio or not. Over the long term, whilst M&A can have an impact, it's ultimately fundamentals they believe will drive performance.
Moving on to some of the specific features of a closed-ended structure, how has a discount moved over the past 12 months?
So the discount has remained relatively wide for much of the past year, and the trust is now trading on a discount in sort of the low teens figure. This level began to widen out in 2022 as interest rates began to rise to combat the high inflation, which has affected BRSC's rating both in absolute terms and relative to peers. The discount of the trust had traded at a premium to the peer group during 2020 and 2021. However, this changed in early 2022, and BRSC moved to a wider discount to the sector average. The current discount level is wider than the trust's own 5-year average of about 9%, and in line with UK smaller companies peer group of about 13.2% on average, showing that the premium rating versus peers has also evaporated. The factors that cause this discount to widen, such as higher inflation and higher interest rates, have begun to reverse, and yet the discount remains as wide as before. We believe that this could be seen as an opportunity for long-term investors. The board has taken the opportunity to buy back shares in 2024. This was done with the goal of lowering the volatility of the share price, and the board maintain the ability to buy back further shares and will do so if they believe it will be in the long-term benefit of shareholders.
And what's the trust's current dividend policy?
So the primary goal of BRSC is to generate long-term capital returns. However, it does have a really good long-term track record of dividend growth, which we believe adds an extra element to the investment case of the trust. The goal is to continue to grow the dividend over time, as the board has done for the previous 21 years. This has made BRSC one of the AIC's dividend heroes. The income generation of the underlying portfolio is largely an output of the process and not a target for Roland. He focuses on high-quality cash-generative businesses, and these often produce modest dividends as a function of their strong operations. The most recent annual dividend was 42 pence per share, and this makes an historic yield of around 3% on the trust. This may not seem high versus more income-focused asset classes, but the growth of smaller companies over the long term has been impressive, particularly the dividend growth of the trust. The trust recently announced an interim dividend of 15.5 pence per share, and this was about a 3% rise on the interim amount of the previous financial year. Despite this good track record, the trust continues to hold decent revenue reserves, which are about 95% of the dividend paid in the previous year. As such, we believe the dividend growth is likely to continue for the foreseeable future, and therefore investors should see it and its growth potential as an attractive feature of investing in the trust.
One final question for you. After a challenging few years, UK small cap indices have started to tick up this year. What do you see as the primary catalyst for a sustained recovery in the sector?
We think that valuations continue to be attractive for UK small caps, not just against their own history, but also versus international peers. This has arguably put UK small caps at double discount, as they are attractively valued versus large cap equivalents, and then also versus international comparators. Lots of this is arguably driven by considerable negative sentiment surrounding the UK over the past few years. Investors were initially concerned over inflation and higher interest rates, and this was not helped by a particularly volatile political environment. This was arguably settled with the election over the summer, only for concerns to emerge again over the budget and the so-called fiscal black hole, with the implications for businesses, particularly smaller companies, still a question. However, looking forward, these issues are arguably behind us, with few near-term concerns to worry about. Roland recently highlighted factors such as rising real wages, good disposable income figures, and the Lloyd's Business Confidence Survey being back to pre-COVID levels and above its long-term average as reasons for this optimism. Despite this, he argues that valuations remain very compelling, particularly in the growth stocks in which he specialises, where the premium rating has come down significantly regardless of the good underlying fundamentals of these businesses. As such, if sentiment does come back, we believe that there are strong signs for significant upside potential. So whilst this may not be a specific catalyst, we believe that a turn in sentiment could help lead a market recovery. The long-term performance of small caps speak for themselves, and while there are always been periods of difficulty over the long term, they do tend to perform, which we believe should provide encouragement for investors with a long-term horizon. With the asset class having had a number of years of outflows, there are arguably lots of investors sitting on the sidelines, which we believe could come back into the space as they recognise the recovery, and that could begin a new cycle of small cap outperformance.
Thank you. That's a very positive note on which to end. And many thanks to Ryan for joining us today.
Thank you very much.
I'd encourage you to visit BRSC's website to find out more information about the trust, including their latest fact sheet and insight articles. We also have a wealth of information available on the Kepler Trust Intelligence website, including our latest research note on the trust. Thank you very much for listening, and we hope you join us again soon for another edition of Trust Issues.
Past performance is not a reliable indicator of future results. The value of investments can fall as well as rise, and you may get back less than you invested when you decide to sell your investments. It is strongly recommended that if you are a private investor, independent financial advice should be taken before making any investment or financial decision. Please be aware that there can be a time lag when we release podcasts, meaning time-sensitive information may no longer be accurate at the time of publication. Kepler Partners LLP has a relationship with some of the companies covered in this podcast, which may impair its objectivity. Kepler Partners LLP is authorized and regulated by the Financial Conduct Authority.